Let's examine equity a little bit. What you see here is a chart which sort of looks very complicated, but really it's quite simple, and the lessons we want to draw from that are two or three very important ones. This is the graph of the Standard & Poor S&P Index over the last 150 years. How the index has moved. And what is an index? Index is a composition of a number of shares weighed in certain fashion. That is, these shares are in different volumes put together to form this index, which is called the S&P Index. And how the index moves also reflects how the individual share prices move predominantly. And therefore, the index is an indication of the health of the share market. And what you have is the S&P 500. What this shows are a few things. We are not here to do a technical examination of it to say what is the trend and so on, but you observe certain things. There have been periods of time when you see the graph which is flat. And sometimes this is not just for a short period of time, it is for years. Which means if you have invested in a stock market based on a passive fund, which means a fund which is linked to an index like this, a return is not guaranteed at all. You could have invested $10,000 and it could have remained $10,000 for a couple of years, giving you cause for anxiety. And therefore, the first lesson is investing in stock market, especially for your retirement fund and for investments, is not a hobby, is not a pastime, and one must seek help and guidance, typically from an investment advisor. And we will talk a little more about how to choose an investment advisor. But suffice to say, you may choose to have a small kitty with you and so-called play the market to buy and sell shares. But when it comes to your personal investments based on your valuable saving, better to seek help. And even if you're doing it, better to seek advice, and based on that advice, do the investment. This is number one. The second important thing to note here is timing the market is not a good thing. When you try to buy at some point in time and sell at some point in time, you always end up at some point on the wrong side of the whole thing and you lose money. However, when you have invested substantial amount of money in the stock market, again an expert is needed to say, when do you move to cash, which means sell most of it and remain in cash and wait for the market to go down, reinvest it and then take it forward. So there are terms like balancing, rebalancing, which you need to do from time to time in the stock market so that you get a reasonable return out of it. The third, as you look at this, you will realize in the long term, it is ridiculous for people to speak saying that I doubled my money or tripled my money or quadrupled my money. These things don't happen. It can happen with a small amount of money with one stock or two stocks. But when you're talking of 10 years of savings going into investment month on month or year on year, returns will be what they are. They will regress to the mean, and the mean is about 10%, 11%, 12%, which is what you would see. And therefore, expectations have to be set. Stock market will give you a return much higher than debt, much higher than perhaps real estate very often. But it won't double or triple your money instantly. That's not the way to go. And that's not investment. That's gambling, or that's trading at best. And you must be clear of that. These are some of the things which you see in this graph which is provided here. And therefore, the underlying message here is investment in stock market needs expert help as you move forward.
Thank you for watching. If you want to dive deeper into this topic and stay updated on our latest content, be sure to subscribe now. And if you found this video helpful, don't hesitate to share it with someone you know. Let's spread the knowledge and the fun together.